We're going to continue on with what we call the accounting principles. So generally accepted accounting principles, the acronym is GAAP, G-A-A-P, is nothing more than a collection of accounting standards, principles, and concepts and assumptions. Okay, so principles and assumptions mean that we all do the same thing. And this was established so that all accountants follow the same guidelines and principles. Otherwise, you will have people doing all sorts of creative things that really aren't important and could actually hurt the company. So I do test a little bit on this, understanding what GAAP is. There are actually 8 principles. We're not going to talk about them all today, but we'll see them throughout the semester. So just so you know that in the United States, the FASB is the responsible party for developing the accounting principles. The SEC, this is the only government agency in control over companies' financials, and this is only if the company is publicly traded on the stock exchange. If the company is privately held, in other words, they don't trade their stock on the stock exchange, there is no government agency controlling or looking at your financials. And of course, outside the United States, there's an IASB. So we're going to be looking at financial information, and 2 extremely important things of characteristics of financial information are that it has to be relevant and it has to be faithful representation. So relevant means that it impacts my decision making. Relevant usually has to do with anything that will change my financial picture in any way whatsoever. Faithful representation means that I'm telling you the truth when I tell you that I paid X amount of money for a piece of equipment or building. So faithful representation means that you have some sort of documentation to back up what you say your company's worth is or its value. So we're going to move to the assumptions here. We're going to cover 4 of the assumptions today on the next slide. These are the 4 financial assumptions. You don't have to worry about them. I don't normally test on these things, but they're very important to know. So we're going to look at monetary unit, time period, business entity, and going concern. And if I were to tell you, to me, business entity is the most important one there is. So monetary unit assumption assumes that we're dealing in some sort of single currency. So for the United States, it assumes that, that's what an assumption does, assumes that we're dealing with US dollars. If you were operating in Japan, the assumption would be it would be the yen. In Europe, the assumption would be it would be the euro. So a monetary unit assumption just assumes that every company in the US is dealing in US dollars. So next we have time period assumptions. So a time period assumption says basically that we can expect the company to report its activities on a regular basis. Now it could be every month, it could be every quarter, it could be once a year. But time period assumption says, hey, this company will release its information on a consistent basis the same time every year, every month, every quarter. Hope I'm not going too fast for some of you. Okay, now the business entity assumption says that basically, let me tell you what it says in my words. Business entity assumption assumes that any activity the business does is separate from its owners. I had my own corporation. It was called Diamond Engineering. I took my personal money and invested it into Diamond Engineering. But anything that Diamond Engineering did not affect me personally. So the owner is separate from its corporation or its business. And since we're talking about this, we really need to talk about different forms of business entities. So you will learn this if you ever do an intro to business class. These are the different types of entities. A proprietorship. This is one person starting a company. Everything happens around that. A partnership is is owned by two or more individuals, but it's still everything involved with those two people. A corporation is an organized entity under the state. So if you are talking about an incorporation or corporation, the business itself is always separate from the company. The owners. So for this whole semester, we're going to be a corporation, and we're going to talk from a corporation perspective. And then there's a little LLC. Again, I do not test on this material. Finally, the last assumption is called the going concern assumption. And it assumes that you will continue running your operation the way you've been doing it. It assumes that you're going to be in operation in the future. That's kind of what it means. Okay, so these are the 4 assumptions. We're now going to look at what we call the 4 principles. Very, very important also. These are the guidelines for all accountants. Here are the 4 principles: measurement, historical cost, revenue recognition, expense recognition. And I have a slide for each of these. So the measurement principle says, how will I record and report information? Says and this is basically when I'm buying something, when I'm paying for something. I have to have it objective and verifiable. Okay? So if I tell the bank that I bought a piece of equipment for $10,000, then I actually have a bill of sale showing that I paid that much for it, and I'm actually able to put it on my books at $10,000. Okay, so objective and verifiable. Objective means I have proof. Subjective means that I kind of feel this is what my equipment is worth. So we want everything to be objective. So this is the measurement principle. So next we're going to look at what we call the cost principle. The cost principle says just this: if I pay $10,000 for that equipment, that's what I put it on my books at. I put the value on my books at what I actually pay for it. Nothing less, nothing more. This is called the cost principle. So next we have revenue recognition principle. Just so you know, revenue is the money that you earn when you're providing a service to businesses or to customers. So the revenue recognition principle says this: revenue is recorded when the services have been performed or goods delivered to the customer. So in other words, my revenue is recognized the minute I provide you the service, whether or not you have paid me. Real important. Whether or not you've paid me, the revenue goes on the books the minute I actually provide a service. For example, if I was a pool cleaning person and you had a pool and I came out today and cleaned your pool and I charged you $100, that $100 would go on my books today as revenue, even though you may not pay me till next month. Okay? So last, we're going to look at the expense recognition principle. So expenses are money I spend that helps me make money or generate revenue. So you've heard it takes money to make money. Well, the expenses are the money it takes. So the expense recognition principle is also called the matching principle. So what it says, remember, I'm a pool cleaning person. So on my way to clean your pool today, I had to stop at the pool supply place and buy chlorine tabs, filters, and other chemicals that I would need to work on your pool. So the cost of those items are expenses, and I incurred them today, so I would match them to the revenue generated today when I cleaned your pool. So expenses are recorded in the same period as the related revenue. I wouldn't record the expenses next month, but I would do it today. So this concludes the 8 assumptions and principles for accounting.